At the beginning of the year, it seemed that the Indian economy was cruising along. Initial estimates suggested that India would grow at over 7% this year. But the July-September quarter growth numbers stunned everyone as GDP growth slumped to a 7-quarter low of 5.4%. The biggest question at this moment as we dive into 2025 is whether the slump in growth is temporary. Is the fall restricted to 1 quarter of flailing growth, or is the slowdown more structural and long-lasting? To talk about the India economic outlook for 2025, I'm joined on this special discussion by 3 sharp economic minds. I want to introduce Neelkant Mishra, the Chief Economist at Axis Bank and the Chairperson of the Unique Identification Authority of India, better known as Aadhaar. I have Dr. Ratin Roy, former Director of National Institute of Public Finance and Policy and a distinguished professor at the Kautilya School of Public Policy. And we have Dr. Soumyakanti Ghosh, member of the 16th Finance Commission and Group Chief Economic Advisor at the State Bank of India. Neelkant Mishra, I'll start with you. The biggest question really, I think television and everybody else should be talking about this one question much more than anything else, is whether that Q2 dip in growth to 5.4% that we saw, is it a 1-quarter slump in growth numbers, or do you see this as being indicative of a longer-lasting slowdown in India's growth trajectory?
Well, I think there is one-off nature to this. The economy saw unintended, and I'll clarify what I mean by unintended sharp fiscal and monetary consolidation in the first half of the fiscal year, and that really drove the growth slowdown to be that sharp. I mean, there are some more longer-term challenges, and we can discuss that later. On the fiscal side, in the first half of the fiscal year, the central government incurred about 29% of its usual fiscal deficit. So if there is a 100 rupee target for the full year, generally the government incurs about 62 rupees. This time it incurred 29 rupees. So there was a 33% slippage on the full year fiscal target, which means 1.6 percentage points of GDP of unintended consolidation for various reasons. So this was a very fast pace. So if you just annualize that, that's like 3% of GDP. That has started to normalize. So it is reasonable to expect that as we enter FY26, the tailwinds of a late year splurge will be supporting us. On the monetary side, while I think the RBI has very limited room to cut rates, I think there has been a slip up on the quantitative side. The quantity of money available. If you remember, there was a lot of debate on the deposits there not being there in the system. Deposits in the system are a macro variable controlled by the central bank. And that was a major reason for the shortfall. Around the beginning of the fiscal year, the central bank became overly focused on the credit deposit ratios. Banks were asked to bring down that ratio. As the banks slowed down credit, it actually accelerated a downward spiral. And credit growth has declined from 17% to less than 11%. If you see that pace of monetary of financial tightening, obviously the credit GDP growth will slow down. With the CRR cut and hopefully with some more backing off from the regulator, if the credit growth revises from here, I think it's reasonable to expect that FY26 could be upwards of 6.5%, maybe even 7% growth.
So let me put that same question to Dr. Ratin Roy, and I want to show you these estimates put out by different agencies and research houses, all of which have corrected what they think will be India's growth number for this fiscal year. Initially, the forecasts were far more buoyant than currently. Each of those, and you've got them on your screen right now, pulling back by about 0.5 percentage point roughly over what they were expecting earlier. Ratin Roy, Neelkant Mishra makes the point that in the second half of this fiscal H2, that there will be greater government spend and there will be a catch-up effect. And while there was a slump in growth in the second quarter of this fiscal, we will soon be bouncing back. Is that your assessment as well? And what's your economic outlook for next year?
Well, first let me say that I don't do astrology, unlike any of these forecasters there. And they have the luxury, unlike most astrologers, of revising their astrology. I haven't seen any credible modeling backing these so-called forecasts. These are basically very crude exercises. And they're meant for an audience, a Bombay market audience. So it's okay. But I don't think we should take them too seriously. And in that sweeping statement I've made, I'll include the IMF and the World Bank for other different reasons. So it's not just our chaps. Now, in terms of growth, I agree with Neelkant. I agree with Neelkant that we will perform moderately well as we have moderately well in the past. I'm not sure we'll get to 7, but unless you do something to deeply damage the economy, like demonetization, 6 to 6.5% growth typically would be what you would expect, as an average over a 3 to 4 to 5 year period. That is the fact that is not enough and its quality is very poor, either from an employment perspective or from a well-being perspective or from a prosperity perspective, is a structural matter. But I think Neelkant is right for the reasons he adduced. But just to give you one example, I mean, if the growth rate of a market economy is so dependent on fluctuations in government spending, then something is clearly wrong with the economy in terms of its structure. So with those caveats, I would say that the proximate causes that Neelkant gives are quite correct. I'm not quite sure about the credit growth story there. I mean, possibly that is also happening on the demand, purely because of lack of demand in the right places. The other factor I would add is the extent to which, given world trends, nothing to do with India, well, nothing majorly to do with India, foreign investors behave with respect to increasing or maintaining their investments in the Indian economy, both in terms of FDI and in terms of FII. Outlook-wise, therefore, I would say that we will continue on the path of amiable but stable mediocrity that the economy has been on for the last 3 or 4 years. And I see nothing in the bargain to change that. That does have terrible implications in terms of jobs, for example, good jobs. It has terrible implications in terms of the ability to invest in health and education, both on the public sector side and the private sector side. It has terrible implications in terms of India matching up to being the 3rd largest economy in the world in terms of also seeing a quantum increase in prosperity of the bulk of its population. But on the macro side, I agree with Neelkant. I think we will hit comfortably unless somebody screws up again, and there's plenty of room for that. You've seen that on track record. Unless someone screws up again, 6.5 is what you'd actually...
You're calling it amiable but stable mediocrity. Soumyakanti Ghosh, first let's just focus on what's left of this year and try and get your sense at SBI about what you estimate will happen and how much do you think the bounce back will be, what explains the slump, and secondly, your economic outlook for the next fiscal.
Yeah, thank you, Rahul. I think, Rahul, just before I start, I'll just put to it an interesting data. In the last 33 years since Indian economy liberalized from 1991 to 2024, if you look at the average growth rate, that has been at 6.1%. And interestingly, in the last decade and this decade, if we exclude the years of the global financial crisis and the years of the COVID, the two growth rates have been at 7.2% for the last decade and 7.3% for the decade ending 2024. So the aspiration of India actually has moved higher from a 6% to 6.5% growth rate to 7% growth rate. So therefore, the 5.4% growth rate in the second quarter was a disappointment. But I would like to add to the point that there has been some factors concerned. Some of the points Neelkant mentioned. I just want to add another point which is extremely important from an economic perspective. I think there has we have seen a significant slowdown in the capital expenditure on the part of the states. Actually, the states have been undertaking a lot of revenue expenditure, but there is also an support which the central government gives in terms of an interest-free capital expenditure. I think this year the budget was presented in July, and the contours of that package was worked out in the month of August. So if you look into the first quarter data of almost all states, including the larger states, there has been a significant and sharp slowdown in capital expenditure. So that is also hurting the economy. The second point to note is that I think there has been significant geopolitical uncertainty. The manufacturing sector, which has actually slowed down the most in the second quarter, I think a growth rate of 4%, has been hit by also declining margins. I think that's a statistical artifact, which I don't want to get into it. But I think much of that will correct possibly in the second half. It is debatable how much it will correct so that we can have a growth rate in excess of 6.5%. But a growth rate in excess of 6% looks reasonable at this point of time for this fiscal.
Okay.